So that is a little advantage, but that advantage is only up to expiration. Series of questions. Okay. So put premiums, as we discussed, that when market goes up, put premium will always be giving you a profit as time. If market is neutral, you will see put premiums again giving you a positive. And when market goes down, as long as it's within your deductible range, you will see profit in all cases. So whether market is going up, neutral, or going down, within your deductible range of the put, you will see a profit, and that all region is profit. Outside your deductible range, if it continues to go down, you will make loss, which is same as if you're buying the stock and holding it. So, and I remember in my initial flyer, I did mention that you make money in good market and then not so good market. And what I meant by it, that green being the good market, but yellow and red area here is not so good market. You cannot make money if you're just buying and selling stocks, but you can make money with put writing. Does anybody remember in recent times when was the stock markets didn't do well in general? Anyone? I have some. Let's see financial crisis. This is the chart from financial crisis 2008 and 2009. S&P 500 is red. CBOE put writing index, which is Chicago Board of Exchange, Chicago Board of Options Exchange, put write index on S&P 500 is gray line, performed better. You remember 2018 dip. Some of you didn't see much, but that was a dip towards the end of 2018. Again, put writing beat S&P 500. And March 2020 dip, since it was such a short, and it's very important that I candidly and honestly show that in that particular, because market came back up very fast, S&P 500 beat the put writing index. And that is because not when it was going down, but it was in a speedy recovery, much faster recovery than if you had puts. So here is an example. We will take Apple put with strike price of 120. The capital requirement is 12,000, what we saw example last time as well. The premium is here is I've assumed $65 on 100 shares or 0.65 premium per share. So you will receive $65 upfront. Your capital at risk is 12,000 minus 65 that you already received, which is 65 divided by 11935. And this 14 is number of days. So if it's if the contract is 14 days, 2 weeks out, you will divide it by 14, and to make it annual return, you will use 365 days. That's how you will calculate your annualized return. So 65 cents for 2 weeks on a 12,000. Sometimes it looks very low, but you're getting a 14.2 annualized return. Any questions here, or should I take on one more example? Anybody? 2 months, 60 divided by 365, and it's 15.8% is the correct. But if you do it at 60 days, it would be little higher. The next section is little heavier in terms of complexity, but just because it has some theory to it. But I'll make sure that I go slowly, and if I lose you, please ask me or stop me and ask me. So premium relationship to price. Some of you who have done the trade assignment would know that as strike price increases, your deductible decrease, which is basically market price minus strike price. And premium basically increase because you're willing to take extra risk. If the contract period increases, if you're not writing a 1 week or 2 week, if you're writing a 6 months put, then premium would increase. If stock price start decreasing, premium will also increase. Stock price decreasing is not in your control though. Whereas strike price and contract period, you can select. Stock price, if starts coming down, premium will go up because now you are taking more risk if you basically sell the put. And this is how this is related to put skewness. It's outside today's discussion, but we do have some material on put skewness, and put skewness makes it the whole put writing much more lucrative because you get higher premium when stock price is on the fall. And premium decreases, you will get less premiums on all of the above. So if your contract is shorter, if strike price is low or deductible is very high, then premium will decrease. It's very important when you trade that there is a probability of option puts as well. And this delta or probability of assignment is very important when you do the trading, because this will give you some kind of an indication that how likely it is that put that you're writing will be in the money, or will the market price will be at the strike price at the expiration time. And that's something that you should always look out for. And there are a few slides which is basically some tips of how I handle delta when I do trading. So that's on the premium strike selection. And since now I've given you some concept of OTM, out of the money, in the money, and at the money, as well as delta, which is the probability. Let's look at the Apple's price from May 18th, 2 weeks ago. At that time, stock was trading at 125, and the stock chart was showing for puts different strike price from 118 to 130. 118 to 130 covers all three segments: out of the money, at the money, and in the money. From 18 to 25 is out the money. The premiums are increases as we talked. Delta also increases because the probability of being assigned is also increasing. You would notice that around 125.7, which is the market price, the probability is 50-50. There is a 50% chance that the stock will remain or higher than this price. And the probability of assignment below the strike price is less, and probability of above this is higher. So if you put an order of 130, it's a 94% chance that even if Apple moves upwards, it will not basically go past 130. So your put will remain in the money. Out of the money, premium, if you see premiums, premium received 60 cents, probability is only 7.6. This is the 120. At the money, 125, you get a higher premium, probability is also higher, and your break even becomes 123 here because you have 125 minus 1.87. If you are trading in the money, you can also always still write the put. Sometimes people ask me, why would I write put in 129 when stock is trading at 125? You write it because you will still be able to buy it cheap. Your break even is 124.21. So even if you get the stock assigned, you don't have to pay 125.70. You write a put on 129, get the premium. There's an 80% chance, 88% chance you will get the stock, and you will still be basically paying less than the market. And also remember that this contracts are 14 days out. So for 14 days, you don't even have to pay the full price of the stock. So you collect the premium now, and in 2 weeks, you will get the stock. So that's how some investors trade puts, that they write it so they can get the ownership of the stock, still discounted, and you get premium upfront, which in this case, the example I took of 129, you will get $418 for each contract. What I just said, in the money, at the money, and out the money, out of the money, these are the common use. In the money, people are using to buy stocks on discount. At the money is you're trying to get it on discount, but you're not very sure. If you get it, it's fine. At least I will have some premium. But you're more on the fence that if it comes in my way, like if the key stock continues to trade sideways or upwards, I'll get it. Otherwise, I will basically just keep the premium. And if it is out of the money, which most of my inclination here is that to teach you how to basically generate income, but not to mention that these are also very good strategies if you're looking to buy the stock at discount. I've also put here that you will get highest premium in the money. Your risk is also high, and in the out of the money, your probability of assignment is less, therefore risk is less, but you're also getting a low premium. And then there are certain views on how you have to manage positions, which is basically bullish, balance, and less bullish is when you will do the out of the money. The way I work, and this is another important slide from a practical purpose, is basically if I am looking at a chart, at a put chart, I will open the stock last 3 months or 6 months and see what has been its recent past. If in recent past it has trading around 112, 113, I would mostly put an strike price of around 115, because I can see that in recent past it has not touched 115. And that is what you will do if you are looking at out of the money. If you would like to buy the stock or at the money and get better return on premium, you will come close to 120, where you are seeing there is a chance of it getting exercised. And I don't mind getting the put if it comes, but if there is a chance that I can only get the premium, you will be around 120. Because even in 120, if you see, it's still, the price has been here at 3 months and there was a good support. And every time when it came around 119, 120, the stock has moved back to above 120. So that's how I look at it, and I decide my strike price, that where I would like to be on the strike price. And premium, of course, goes with my risk tolerance here. If I go with 110, premium would be very less. If I go even lesser, 100 or 95, the premiums will be extremely less. This is another example that if this is the chart of a 5-year OCGN, Ocugen Inc., this is the one of the stock which premiums, weekly premiums gives you a 350% just by cash, not taking account margin. But I would stay away if stock is going from 160, 170 to $8. this is something that I would not even trade, although it's quite stable around $8. But I wanted to show you that what kind of premiums you can get if you are willing to take some risk. These are another, which I won't call it stock selection, strike price selection, it's more stock selection. As we looked at earlier in the slides, that when the stock is downtrend, I would stay away. If stock is going like this between March 1st and May 24th, I wouldn't go into it, because most than likely it will get assigned and I will have to own the stock. Splunk, a very big company, most people are saying this is trading far below its fair value. That's another one which I would have not get into, because in December it was at 200, right now it's at 120. So what I'm trying to tell you here is that when you decide to put a put for selling, you look at the charts and decide the strike price, as opposed to just going by your gut feel. Look at the chart, see if it is downward trend, sideways trend, upwards trend. As we looked at earlier, if stock is in upward trend, sideways trend, or a little bit down, there is a good chance you will keep the money. The one that we saw here, it's more sideways, and maybe somebody can argue that it is little on the low, but this is a good chance you will keep the premium. This is a stable but very risky. These are in downward trends. Remember, these are just 90 days and 120 days charts. Sorry, this is 3-month chart and this is 6-month chart. We looked at delta, which is, any questions? No, good. This is the delta which we just look at. It's the probability of assignment. I use that heavily before I put the order in. There is another Greek out there, which you will see in your course, is called theta, which is time decay. And what is time decay? I will explain it here. Here are the two charts from July 2nd of the same stock. July 2nd, 2021, which is about 6 weeks. And this was 1 week. I took this a few days back. If you look at strike price of 125, the theta here is 5.3. And theta here is 15.2. You multiply by 100 to get the percentage. So for May 28th, which is expiring in few days, the theta is 15.2. What 15.2 tells us is that the premiums are decaying very fast right now. When when contract expiration approaches, the theta increases, the value of the premium goes down very fast. So if you're a trader, if you are making money through premium, it's important to know that when theta is high, every day that stock is above the strike price, you're making money faster. Your premium is basically being in your pocket faster. What I call it sometimes earned money versus unearned money. And if it is 3 or 4 months out in the future, the theta is lower, the time decay is lesser, and therefore what happens is that your premiums are basically becoming yours, or realizing, or you are earning the premium every day, but at a slower speed. Here is the same thing graphically, that if it is 90 days out, if you see the time decay is slow, but it accelerates in the last week or two. As it approaches the expiration, it's faster. The chances of you keeping the premium accelerates here. And that is a good thing. And that's why I sometimes tell people, to go for shorter expiry, even though the premiums are smaller. This is the same thing explaining a little differently to reinforce the idea. Apple stocks of June 18th, if the strike price is 120, the premium is 158. So it's a 1 month. I took this chart from around May 18th. So 1 month Apple's put is giving you $1.58 in premium, and a 4 month, so from May 18th to September 17th, will give you $5.15. So yes, it looks good that you will get $500 today, but it's a period of 4 months. If you do 4 times monthly puts at $1.58, your total premium collection will be $632 versus you do only 1 contract for 4 months. Of course, I'm assuming that stock hasn't moved much. So shorter contracts are better. Over time, you will make more money in premiums. Yes, you will see only $1.58. And if this is a monthly, if you will see weekly, it won't be even 50 cents. You will see 45 cents around for each week. But over 4 weeks, the weekly 40 cents will give you more than $1.58. So that's important when you are selecting your expiration date. Select expiration, I usually use the shortest expiration, as long as it is in my target annualized return. If I'm looking for a 10% or 12% annualized return, I just make sure it's the shortest expiration in which I can collect premium to meet my 10% or 12% target. If your target is, let's say, 15 or 18%, then keep this expiration date as close to the today's date, but ensuring that whatever your targeting rate of return is, you meet it. Target, as I said, target IRR is the most important factor. If you are a long-term investor and you're basically trying to get the stock on discount, it is typical to select expiration few months down the road, or at least a month. Why? Because then you will see a discounted price. Otherwise, what you will see is just 20 cents discount or 15 cents discount on a $120 share. If you're really looking for a $4 or $5 discount, it's typical that long-term traders put the contract out 2 months, 3 months. But that is for people who are using this put writing strategy for long-term. It's the same idea. I've not completed the topic. I just thought to pause. If a stock is a blue chip stock and low volatility, Pfizer, J&J, Enbridge, Sunoco, all those stocks, I think you can safely go with, and this is, I'm not recommending here, but this is my style. I go with 20% delta, which is 20% probability of it being assigned to me. If a stock is a good stock, it's a blue chip stock with a higher delta, usually it comes in tech stocks. I keep 10% delta. Tech stocks like Microsoft, Apple, that's my style usually, is that I trade at 10%. And I again like to repeat that I usually target around 10%, 12% annual interest rate or annualized return. If you are targeting more, there is a good chance you have to increase the delta. You cannot expect at 10% a 20% return. If you're trading in Tesla or Moderna or any volatile stock which has big in the news these days, which has a strong capital growth projection, I try to keep it at 3%, 7%. So because they are very volatile, they move week to week, 5%, 10% in their pricing. So if a stock is like a Tesla stock trading around 620 this week, next week it could be trading around 550, which is almost 10, 12% off. And if you want to avoid the assignment, you want to write it at 510, 520 for a week, and that you will get at 5 or 7% delta. If you do a 10% delta on Tesla, you are expecting that you will basically, it's a good chance you will get the assignment if stock really moves against you. So the next is put writing risk management. Now that I have covered, unless you have questions here, for how to initiate a trade, what I covered in different ways, the delta, what to select the delta, how to select the strike price, how to select your premiums, and based on your trading style, make sure you are clear of what your target yield is. If you don't have a clear vision of you're targeting 10, 12% a year, 5, 6% a year, or 30% a year, you will be very confused that what strike price I should select, because they all move in, as I said in the beginning, they all move accordingly. They're all very much related. Price, premium, delta, they're all work together. So if you're clear on your rate of return, when I trade, I have a simple spreadsheet, pre-calculated. I just put the premium, strike price, and number of days. And it tells me annualized rate, the way we calculated in the first part of the seminar of this session. I've created, so I immediately put those 3 things and I know how much annualized rate I'm getting. If it's 7 or 8%, I move my delta higher, my strike price higher, so I can get my 10%. And that's how I basically say. Sometimes if I don't get it in my range, I change the expiry date from 1 week to another week. I don't go just to get my rate a 30% delta or a 50% delta. Then I'm basically shooting myself in the foot. What I do in that case, forget about this week, go out week X, a week, like 2 weeks out. And if I get my premium that satisfies my rate of return, I will put the premium in. Thank you. Now we will turn to position management. Now, position management is basically, after selling the put, you have following options. You can leave it as is, as long as you are seeing that, let's say the same example of Apple, trading at 125, 127, you put a put sell for 120, and now you're seeing that your expiration is coming closer and closer, and Apple continues to trade above 120. You can leave it as is. There are some things you can still do, but I will leave it for a later discussion. You can close the strategy. It is when you, one of the questions that somebody asked me, can you buy it back? Yes, you can buy it back if you are not happy with your decision of 120. You might have to take some loss, but if it is better, if you think that you missed something, you've made a trade at 120 and now you're reading about Apple, that it might hit 110, or economy has started to go south, COVID has come, or something like that has happened, you can take $100, $50 loss and don't wait for assignment, because once it's assigned, you have to own the stock and maybe you can't do much. Or you adjust the strategy. Adjust the strategy is basically you buy it back and you sell it for 110 for next week, or 115 for the next week. You can do that. So even if you lose $50 or $100, but you can cover that $50 or $100 by selling another put for a lower stock, lower strike price, or for a, you extended your expiration date by a week or 2. So you can do all of these 3 techniques when you're managing. I tell most people, don't be too optimistic. If its stock is seeing, it has already come at 120 and you have a week or full trading days to go, you can adjust it right there and then. Don't wait for expiration date to adjust the thing, because more you wait, the more expensive put will get. So if you sold it for $30 and you can now buy it back for 60, your loss may be $30. It's better you take that loss, unless you see that it was just a blip because some bad news came and in few days it will adjust or it go back, then it's fine. You can take that risk. But if you are not sure, it's better to be cautious, take some loss, sell another put for another date, which we refer this as rollover, which is basically you are buying buying your put back and you're selling a put again and trying to cover your loss. So you don't have a full loss, but at the same time, you have protected yourself from assignment. And that is very important. Always remember that you cannot be right. You will make mistakes. You will be on the wrong side of the trade. Decide early if you want assignment or you would like to adjust your strategy. You can also close the strategy if you made a totally wrong decision on the stock. The scenarios are basically, as long as stock trades above the strike price, you can keep the premium. If your put is near or below the strike price, close the contract. I'm just repeating, buy back or change your strike price or expiration date. This is depending all on what's your outlook of the stock. And sometimes if you are so confident about the stock, which I sometimes are with some of the ETFs like S&P 500 or QQQ, if I get the assignment, I take the assignment. Once you have taken the assignment, I know it's not part of today's discussion, but you can always write covered calls. Put is where you write to acquire the stock. Call is what you do when you want to get rid of the stock. So if you have got the assignment, you can continue to write covered calls, continue to collect premium on your asset, which we call it, you basically are collecting rents on your house. Is the same way when you buy a stock, you can collect rent by selling covered call on it every week. So you still have an income generation stream out there. You were using put stream at the beginning until you get it assigned. Once you get the stock, you start writing calls to it, your income generation week over week continues. But be careful, don't hold a loser. If you think it is not a great stock, then don't even write covered calls on it, because covered calls only means that you like the stock, you want to collect rent, but you are fine if somebody pays you a price that you want. But like house, if it's not a great property, if it is just sinking you, get out of it. One advice, manage risk right after you have sold it. Don't leave it to the expiration date, because sometimes at the time of expiry, the delta is at 100%, meaning there is no chance you can do anything. Even rollover will become difficult because price is gone so high that you cannot buy back or anything. So if you manage it properly, it will be something that you will be able to do it easily at the beginning when things are moving south. Assuming you have sold a put on a less volatile blue chip stock like Apple, like Microsoft, if the delta is at 25%, you have to start following it. Because if you started at 10 or 15% or 5% and it has moved to 25%, you should start looking at it. It requires your attention, what you do with it. If it's in 40 to 60% range, it requires action as well. Because if you want to buy it back, this is the time, between 40 and 60%. If you want to roll over, this is the time. If the delta goes to 60% to 80%, you should reevaluate the stock whether you want the assignment or you want to cut your losses. This is that time. If it goes above 80%, what I have seen, I'm not saying this will always happen. What I have seen, your options of other strategies are decreasing. More than likely, you will be assigned. You can roll over, but chances of rolling over is that you will pay such a high premium to buy it back that you will always feel that I only got $50, now I'm paying $300 to buy it back. And that is why act before 60% or around 60, 70%. After 80%, your options are limiting, and you be prepared to either take the ownership and write covered calls on it, or you also have a chance that I was wrong, I'm buying it back, I'll take the loss. About people who are here not interested in week-to-week income and money making, if you're interested only in long-term investment, this is basically, I'd like to show that Apple strike price at 127, which is in the money, above this market price. Market price is around 126.75. You will get a $3 for your put, and that brings your effective value to buy the Apple stock is 124, because you will get $3 and you will pay 127. If you don't do the put, you will have to pay 126.75. But this strategy will allow you to buy Apple at 124. Use first, determine what you would like your yield and annualized returns to be: 6 to 18%, 10 to 14%, 12 to 20%, whatever, 30%, 5%, and try to stay within it. It is very normal. I have seen a lot of people beginning 30 cents, 40 cents. They are so excited. They are fine for weeks. And then gradually they go to 30% and 40%, and they come for a coaching session. And then when I see this difference, well, you're looking at 12%, but what you're targeting is 20, 25%. And they tell me, oh, that 5, 6 cents or 30 cents are too little for me. Make sure you use annualized rate. You don't look at the absolute premium. You can start with my delta range, which I said for most stocks, I try keep it 10%. And for some of the Tesla ones, I keep it around 5, 7%. Or you can look at the YouTubers out there. I'm not the only one with the put course. There are so many YouTubes out there. You can use any suggestion. But after a few weeks, let's say a month or 6 weeks, once you have traded 10 or 20 contracts, you can get your own idea of where to basically start. 10% is good, or 8% is good, or 20% is good. And that's how you go. And it doesn't have to be the same. If you read somebody like a COVID happens, or now that we are reading that markets are in a bubble and it might have a burst, you can decrease your delta. As soon as you see that I don't want to be too risky, you can decrease your delta for a few weeks until the storm is over. Select the stocks you like to buy, okay, an acceptable price point. This is very important. We have talked about it last week. Someone asked me which stocks to go with. Do your fundamental research, which stocks you want to play. If you're not comfortable with stocks like that I mentioned, Splunk or GME, that has 300 and 600% price returns, you don't have to go into them. You can still make good 10, 15% a year on your capital and not get into stocks that you don't want to buy. Look at 3-month, 6-month, or 12-month chart to find price points on the chart, and then basically decide what your strike price is. Be comfortable with your strike price. That's how I do it. I start, look at the nearest expiration, look at my premium. If it is within my target return, I put the order. If it's too little, I adjust the strike price a little bit to get the premium I want or annualized return I want. If I cannot, I don't play too risky. I go to the next week and then try to get to the same target return. Adjust strike price, as I said, not by much, because you don't want your delta to be in a zone where you're not comfortable. Before order, review your delta. It's a must, I would say, because you should know what is your probability of assignment before you put on the stop. Final recommendations: stay within your strategy parameters, the stock selection, the premium range, the delta range. When I say premium range, I really mean your yield, premium divided by capital, annualize it. Put writing surely is not a rich quick. We are not hitting any home runs here. You have seen the premiums. These are just getting to the next base. If you are familiar with the baseball, you are trying to be consistent, making 10, 12, 15%, whatever your yield is. And if you're a long-term trader, you're boosting your investments returns by having something while you wait your stock to come in your price range. Or you generate continuous cash flow from this. Last word, consistency is more important than higher returns. It's not a rich quick. You cannot just do 100,000, I put it in Amazon, it became 1 million, I'm out, I don't even need to worry about stock exchange. This is not that. Every week, every month, for next few years, until you have hit your targets, you will have to do this. This is not the example I'm going to give. It's not my example. It's like keeping your tooth clean. If you are only visiting dentist 2 times a year, it's not a good strategy, right? Because it's every day brushing your teeth twice a day. That makes it clean. You cannot just have trades at the beginning of the year or once in 6 months. If you don't have time, don't do put writing. You have to have some time and okay with collecting premiums every week or every month. And that's my final advice, is that you don't look for big runs and home runs here. A word on premium again, another slide to show you that such a small premium, 6 cents, can give you a 47% return. This is Bed Bath and Beyond, 6 cents, a 10.6 return. Many people come to me saying this 10 cents and 12 cents, I'm not into it. I want $1 something or $2 something. But please look at annualized rates. That's what you have to look at. If you look at just the 6 cents and 7 cents, you will miss the whole point here. If